Hello and welcome. Today I'm going to walk you through a case from last weekend's Financial Modeling World Cup. This is the big case for the round. It's called the Fund to Be. You're modeling future investment returns for a private equity fund. And specifically, you're doing it under various different simulated scenarios. So the idea is you're going to make 60 different investments, all of the same initial check of 1.25 million in various different sectors. But then you have these 8 different sort of potential return profiles, which I'll describe a little more in just a sec, that tell you about how these investments are going to perform. And so for each of the 60, you have a return profile, but then you have, just like that one, you have 49 other simulations. So it's like, here's one scenario where your first investment performs like profile 3, and your second performs like profile 1, and your third performs like profile 8, and so on. But then here's another one with different ones, and another one with different ones. So the idea is that you don't want to kind of bank too much on the idea that one particular asset is going to perform when you're looking across a portfolio of 60 different assets. Do you do your returns feel robust across a range of plausible scenarios? So what does one of these investment profiles look like? Well, they're over here. So as an example, and there were example calcs included in the file. Uh, so here, let's say that we make an investment of an initial amount of 1 million on the 31st of December 2024. Well, some of the profiles call for further investment. So in this case, at month 18, we'll make a further investment of the same amount, so 1x the initial investment. So here we invested on the 31st of December 24. We make a further investment on the 30th of June 26, which is another million, and then we exit in month 48 at a multiple of 3x the initial valuation. So we exit on the 31st of December 2028 for $3 million. So you invested 2, you get back 3. Sounds pretty good, but when you factor in the timeline, it's actually only a 13% IRR. Then the next 2 are sort of bangers. They finish at a 10 and a 15x multiple. But and again, it's a sort of test of your intuition for IRRs, because this one requires a bigger investment at 30 months, and because it has to be invested in for a longer time, the IRRs only end up about the same, even though this one ends up, 50% more valuable for the same initial investment. Then you've got another one here that doesn't require a top-up investment, but ends up being exited for a lower value than you bought it for. You've got one here that doesn't require reinvestment and exits at 5x, which again, an interesting one for your intuition, because this one comes out almost as high an IRR as these ones that end up at 10 and 15x, even though it's only 5x, but it's a shorter timeline than them both, and there's no further investment. Then you've got one that no further investment but exits or goes bankrupt at month 36, and another one that requires further investment and still goes bankrupt at month 42, and finally one that exits at even money at month 24. So these are all the 8 different profiles, and then there's equally 8 different valuation profiles here. So they're all worth 1x what you paid for them at month 0, and most of them are still around 1x at month 12. But then some of them start to go up, others don't. So like this one's already falling by then, and is going to be worth 0 by month 36, and so on. Yeah, that's the idea of the profiles, and there are example models of each of these. So you can say, okay, for this profile, this is what it looks like. For this profile, this is what it looks like. So the idea is to be able to say, we're going to apply this whole set of profiles to this whole set of investments 50 different ways and see how the investments look across each of them. Okay, so now that we have the idea, let's dive on into actually modeling these simulations. Okay, so the first thing I'm going to do is, on the day, I kind of went down below and kind of made my own set of calculations and then tried to make sure they match these. But actually, I think a smarter way would be to build it up here. So right now, there's a bunch of things just referencing up to here, up to here, up to various other places. Rather than replacing all of those with a ton of separate lookups, I think what I'm going to do is just bring this down here, and then we'll do XLOOKUP. We can just do choose rows of this, lock by this. And that gives us the profile that we want. So now I just want to replace every reference up to here with corresponding thing down here. So that's the fixed further investment month, is the exit month, so I'll point it to there. That doesn't point to anything up there. This does not point to anything up. Oops, sorry, I didn't tab across. This does point to the further investment multiple, and this points to the exit multiple. So I'll bring that down here. And then hopefully, if I copy this down, we should see that all of the rest of these values don't change, and that is exactly right. But now, there's nothing pointing directly to this table. They're all linked by this. And I guess what I want to do is the same basic thing here, except I've got 5 of these, so I need one more. Take these. No, that's not what I wanted. Never mind. And we'll just say choose rows of this lock by that. Okay, and so now, how is this? Oh, sorry, never mind. That's, oh yeah, because this is just calculating the months. So this isn't where we use that. We use that down here. Fine. Put that down there. This, that's indexing on this, which I don't want, but I'll just make it point straight up here. Oh, whoops, nope, can't make that point straight up there. So I want this to point up to here, and I want this to point to the exit date here. Okay, and then this is only referencing calculations in that row, so then that's all fine. Oh, no, didn't like it when I copied that across. What's going on? Yeah, interesting. Something not locked? What's going on? Oh, it's because I've inserted. Okay, got it. So I just need to put that back to there. And now we're good. And fill down, and we're good. Okay, now one thing to look out for is right now this timeline goes out to July 2031, but, and that might be enough in these scenarios, but let's see, our latest investment date is December 28, and our longest exit timeline is 54 months, which is 4.5 years. So let's just go out to end of 2033 to be safe. So what does that mean? It means I need 1, 2, 3, 4, 5. That gets me to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19. So insert that many. Copy across, and I've gone a little bit too far, but that's fine. And then all of these formulas should also copy across. And then we need to go down here and do the same thing, except now we just need to see where is it referencing. It's probably, yes, it's referencing up here. So I want to replace, this can just come down here, or could have stayed up there, actually, that would have been absolutely fine. And then this, I want to replace that with this. And we can just get rid of that. And then I think everything else should stay the same. So let's just see if I copy that everywhere. I've got a total of 503686. And that stays the same. Okay, so now we've got everything. And just make sure nothing is pointing at this as well. Oh yeah, okay, so these amounts also need to point up here. So the initial amount is going to be from here. And the exit period is going to be from here. Okay, and then it's only pointing there, which is okay. So now that I've got that set up, I want to make each of these into, what have I got, 60 investments? Yeah, so I'll make each of these 60. Slightly more than I wanted, but never mind. So I'm going to point this. Oh, now, sorry, I also want to have a scenario selector here. So let's have scenario. Let's start off with sim1. Just mark that as an input. And then just call it active. And we'll xlookup. Whoops, xlookup this in here. I don't even need to lock returning from here. Okay, so this is my active scenario. So I want to point this to that. get rid of this, and get rid of everything further down. And these refs I'll sort out in a minute, don't worry about that. Okay, then the initial investment dates will be from here, and the initial amounts will be from, oops, didn't go to the top. So start from D8. Okay, good. And then we just need to copy all of these formulas down. And we've got everything modeled there. Okay, and then to do the same thing here, we just need to, again, expand by this. We can get rid of all of these. And then this is just, well, actually, this can just point up to here. So that's the list of scenarios. Then the initial dates will just point to here. Sorry, this one already does, so I just need to copy that down. That one already does. Yeah, so all the rest of it just needs to be copied down. So up to there, and then across, copy everything down, and we're all good. And then finally, we need to do the same thing here. And sorry, we can clean up. We've got too many rows here. So that, point this to here. Kill everything below that. And then, whoops, sorry, back down to here. So this is already pointing to the right place, that's pointing to the right place, so I just need to copy everything down. Okay, happy days. Except this shows I have a bunch of things still being valued right at, oh, okay, yeah, somehow we've gone, right, because I expanded this one, but I did not expand the one below. So let's just copy all these out to the right. And now, hopefully, we should see, yes, everything has been exited by the very end. There's some things still invested at this point. Okay, so now we've got a working set of investment profiles. So for each investment, we can say what the return is, what the different cash flows and dates are, and what the valuation is at any given point in time. Okay, so now that we've got the individual investments model, the next thing we're going to want to do is put together a timeline and start building the model for the whole fund. So this is a pretty, I guess, utility process. So I'm going to go ahead and use my robot command to import my existing timeline. So import timeline, and it's just, you might have seen this in my videos before, but boom, it is, you can set the start date, which is going to be there, I guess +1, oops, 8 +1. Then you can say how many years. We want to go to 33, so that's going to be 8 years, 9 years. I can't count. It's going to be 9 years. And months per period 1, and then we can hide all this because it's not being used. And it gives me just a period counter, start and end dates visible, and then there's also a bunch of other things like the year number, the month number, the quarter, blah, 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 blah. And those all have names for ease of reference. So into that timeline, like the proverbial Christmas tree, we're going to hang some decorations on it, and the decorations we're going to hang are investment cash flows. So investment cash flows. And this is, now that we have the nice setup, this is just so simple it will make you want to weep. So the sum of those cash flows, where these dates are these dates, which are NDT. That's it. And a good kind of sense check, because if your cash flows weren't all at the end of a month, then you might have to do something more complicated to say, less than or equal to this date, greater than or equal to this date. As it happens, all of these investments happen at the end of a month, and you can quickly check that by just saying, well, what's the sum of these? It's 85 million. And what's the sum of all of the cash flows here? It's also 85 million. So if you're building a real life client model, I would suggest being more careful about less than or equal to end date, greater than or equal to start date. But in a competition, once you confirm that everything's coming in, you're kind of fine to keep going. So that's the investment cash flows. Other things we need to think about, we've got slightly different logic during the investment period versus the harvest period. So I'm just going to take this, and I think it's Control Shift P for my paste assumption link, which is just my little robot command that highlights this as something I have used and brings it over here. So then we're going to say if end dt is greater than this, then 2, otherwise 1. So in other words, 1 is going to be investment period, 2 is going to be harvest period. So let's say period 1 equals inv, 2 equals harv. And then we need to think about capital. So let's have a look at the instructions. So the first capital call is 10% of the fund size drawn right at the start, and then further capital is called as required in multiples of 15% of the fund size. So in other words, you can call another, the whole fund size is 100 million, so you call 10 million at first, you can call another 15 million whenever you need it. And how do you decide if you need it? During the investment period at the end of each month, if the cash balance is below the minimum cash of 3 million, then the capital is called at the end of that month. So the cash balance never goes below the minimum of 3 during the investment period unless all the capital has been drawn. It may be possible that all the committed capital is not drawn. We assume all investors pay the capital calls on time, so the called up capital is the same as the paid in capital. And then we'll get to distributions in a second, but let's think about called up capital first. So let's just have fund balance. So we'll have opening, we'll have capital call, distribution, and I'll put in a placeholder for management fees as well. Management fees, and is that it? Yes. No, sorry, investment cash flows, obviously. I'm just going to drop this in the middle here and come there logically. Okay, so then let's see, we've got our first capital call is 10 million, which I guess we can link. I'm just going to put it here. Treat it as the opening balance, or as the initial closing balance. No, I don't like that actually, sorry. Let's need to put it there. And then our additional capital calls I'll put here. So then the closing is going to be the sum of everything above. The opening is going to be the previous period's closing. Whoops, daisy, sorry. I have not hidden my unused columns. You should not copy forever to the right if you still have 16,000 columns visible. Okay, so now we can see, at first we're just investing, so eventually we run out of money, so that's what we're going to need the capital calls for. So now let's have cumulative capital called here, and that can just be sum of that, locking the first column. That'll just be a handy reference point. Okay, so what we want to know is, we also need to know a minimum cash balance, which is 3 million during the investment phase and is 7 million during the harvest phase. So let's grab those two numbers from here, drop them in here. So it's a min cash bal, and we can say just index this by this. So that's 3 million during the investment period, and then the investment period ends, go into the harvest period, and then it's 7 million. Okay. So now we're going to say if the sum of these, meaning the opening balance plus whatever investment cash flows, is less than this. Now I'm just going to say 10 for a second because I want to go check something. I think it said that we only call, yes, capital will be called only in the investment periods and distributions will be made only in the harvest period, which is not insignificant because with the higher cash balance and with follow-on investments and other things, it's not out of the question. In fact, I'm pretty sure it happens that your cash balance falls below the minimum later, and there are some scenarios where not all the capital has been called up by that point, so that's important. So we're going to say if we're below the cash balance and we're in the investment period, then I want to call capital in multiples of 15 million to fill the need. Now, I think you only ever call 15 million at a time, but in principle, we should be able to handle the ability to call more. So what is the general idea? Well, we want to first take our shortfall. So it's going to be sum of these minus this. Sorry, it's going to be the other way around. It's going to be that minus sum of that. That's how far off target you are. And then we're going to want to divide that by the multiple that we can call in, 15 million. So in other words, if it was 16 million short, then we'd have to make 2 of these calls. Then we're going to round that up to 0 decimal places and then multiply by this here. Obviously, you could make the logic simpler if you just said, if it's negative, then call 15. But in principle, like I said, you want to allow for that possibility. The other possibility that you want to allow for is that you've already called all the capital. So you want to say the min of this and a check on this. So I'm just going to link to that for a second, but I need the total capital amount somewhere, which is here. So I'm going to grab that and bring it in. I'll just link it here. So it's the minimum of that and the uncalled capital, which is this lock minus the cumulative capital called as of the previous period. Okay, so then we come along down to here. We've still got a balance of 5 million. Here we drop to 2.5, so we're going to make a capital call. Now we've got loads of money. When do we next drop down? Over here, we drop to 2.5. We're going to make a capital call, back to loads of money, and so on across. And what we find is that we're only calling a total of 85 million. So yeah, basically the things start to pay for themselves before we've called all our capital, because we have a bunch of positive cash flows even while we're still in the investment period. Okay, so that is the capital call. Now let's talk about the distribution. The distributions are made quarterly during the harvest period starting from March 31st, 2029. At each distribution period, all cash above the minimum cash balance is distributed. On the date of fund closure, i.e. the date of exit from the last investment, all the available cash will be distributed. Okay, so we need a few different things here. So first we're going to say if this equals 2, then we'll do something, otherwise 0. Then I guess I really want a flag here for dist period. And actually then I can bake the if it's equal to 2 into that as well. So we'll say this equals 2 times mod month. Oh, actually I've already got monum 3 is equal to 0. And let's just see, that gives us no distributions at first, then first distribution in March, then June, then September, then December, and carry on. Okay, so that looks good. So then here we're going to say if, so it has to be a distribution period, and we need to have more than, well actually we don't even need to have more than, because we can just put a floor on it. So it's going to be the sum of these minus the minimum cash balance, and it's going to be the max of that and 0, and then a negative sign on it, and otherwise 0. That mostly models the distribution, but there's one nuance left, which is the exit date. So here we get to 15 million, we distribute 8 to get back down to 7, happy days. Here we're on 26, we distribute to get back down, blah, blah, blah. But then at the end, we've still got our 7 million minimum cash balance. So what we need is to make sure that we exit at the end. And that means as of our last exit date, which in this case is the end of December 32. But let's just make it dynamic. So we want the max of the exit dates. And I'd like that to be a date, please. So then we're going to say minus, I guess, if this equals this. So if we're at the exit date, then 0. Otherwise, we subtract the minimum balance. And now we should find at our exit right here. Funds closed. We're giving everything back. Okay, happy days. All right, so now on to management fees. And there's a few different things for management fees. During the investment period, we pay 2%. Let's just go to the instructions and read the details. Management fees are charged and paid every month at a fee rate of 1/12 per month on the called up capital balance for the month. Fees for the capital called in December will first be charged in January. So we're just looking at basically the previous month's month end called up capital. Fees are charged up to the fund end date. The rate of management fees is 2% during the investment period of 4 years. With the harvest period, the management fee rate is cut by 40 basis points every year. So for year 5, the fee is 1.6%. For year 6, it's 1.2%, and so on. Okay. So, put this next to here. So our management fees. Well, we're going to need this. I can probably do with. I can use this. And that. Okay. So just for simplicity, I think I'm actually going to have a management fee rate. I'll take these up and use them to calculate that, and then we can just calculate the management fees more straightforwardly. And those are, if they're paid every month. Okay. So it's going to be if this equals 1, then it's just this. Otherwise, it's this minus, I guess it's year num. I'm going to need to link the 4 somewhere as well. Let's just do year num minus this times this. And I'm just going to wrap that in, max at that and 0 just to be safe. Okay, and then here I need to link in the 4. Yes, that. Why is this not working? Oh, it is working. It's just not formatted. Format %. And let's give it 1 decimal place. Okay. So then we've got 2%. Drops to 1.6 in 29. But it's not dropping anymore in 30. Why not? Oh, sorry. Because I've got year num. I need just that period's one, please. Okay. So now. Nope. Okay, I might be forgetting what I called year num. I want, yeah, year num. That looks right. Okay, so why isn't it working? Let's go see. So 0.02 year num 5. Oh, it's just because I didn't lock this because I'm a moron. Okay, so put $1 on that. Copy across. Okay, so now, yes, we go to 1.6% at the start of year 5, to 1.2% at the start of year 6, 0.8, 0.4, and then if you still have money in the fund by 2033, you're not getting management fees for it anymore. Okay, happy days. So then it's going to be minus cumulative called-in capital at the end of the previous period times the fee rate. Something, oh, sorry. Yeah, divided by 12 would help because it's a monthly fee. Okay, that looks more like it. Okay, so now we're mostly there. We got to figure out the carry and the NAV and some of the return ratios. Okay, so the next thing to figure out is the carried interest. Let's take a look at that. To align the interests of managers and investors, there's an incentive fee linked to the investor returns, pretty standard. The managers get an incentive fee called carried interest of 20% of all distributable amounts after the investors have received 120% of the called up capital in distributions. This is a slightly simplified, or not necessarily simplified, but at the simpler end of carried interest calculations, because often it's it's like the investors have to get to a certain IRR rather than just a fixed return. So if the called up capital is 100 million and 120 million has been distributed previously, that means the investors have got to their 120%. The next 10 million is available to distribute. The managers get 2 and the investors get 8 of those distributions. So pretty simple. So let's look at cumulative distributions. And that will just be sum of that, locking the first column. Oops. And I guess I need to make my model columns a little wider because there's lots of oh, right, the distributions are negative from the fund cash flow perspective, but I want them to be positive. Okay. So then, I want my hurdle. I'll link that there. Hurdle, and the hurdle is going to be based on the capital called. So just that times that. So it starts off at just 12 million, ends up at 120 million once the whole thing has been called. I mentioned earlier that not all of the fund was called, but once you factor in the management fees, you do need to call the whole 100 million here. So that's what's going on there. Okay, so then the carry is going to be 20% of whatever we have over the hurdle. So it's going to be max of distributions minus hurdle and 0 times this. That'll be your cumulative carry. Let's just take a look at that. So the first time that we pass the, oh, sorry, that's just distributions beginning. So the first time that we pass the hurdle, pass it by 30 million, and we get 6 million in carry. That makes sense. And then we just need to subtract off the carry that has come before to make it not the cumulative carry, but that period's carry. And so now we're getting a total of 11.35, which makes sense. And yeah, we got our last distribution on the fund close date, which is what we were expecting. Okay, so now let's talk about the net asset value, which is the IRR, and these things are relatively straightforward. This is the only other kind of complicated calculation. So let's talk about this. The NAV is made up of 3 parts. 1, the valuation of your current investments. 2, the cash on hand in the fund. And 3, we subtract off the provisional carried interest. So let's just do these one at a time. The cash we've already got. So the investment valuation. So we'll come over to our valuations page. And now, just to mention here, there was something that really bugged me on the day. I got quite hung up on it when I was looking at these assumptions, because here, for example, it says month 48 valuation 0, but month 48 valuation 3x. I said, okay, well, maybe it's 0 because it's 0 residual value, but you get 3x on the exit. But then there was this one that was month 24, 1x, and also had a 1x in month 24. I was banging my head against this for probably longer than I should have, really. And then when it finally came to ask a question about it, it said, okay, what's the valuation, what's the value of the investments as of X date, excluding anything exited on that date, which kind of meant anything that was in the terminal month was totally irrelevant anyway. So what I want to do is, let's just put it here, total valuation excluding exits. Slightly ambiguous way of putting it, but fine. So then here we're just going to say sum ifs of these 60 numbers, where the exit dates, which are up here, have to be greater than, sorry, I need to lock this one, have to be greater than, yes, and current date. And where we were in this column. Okay, so then that date. Okay, so we've made one investment. It's still valued at 1x, so that's kind of not a super meaningful thing, but anyway. And then off we go. And so, as you would expect, more and more investments, value growing and growing, we get up to a peak, and then at some point we start exiting more than we're entering, and then it starts to taper off again. So that is the valuation. So cash balance is the easy part. That's just going to be wait, what was whoops. Sorry. Yes, the management fees should go up above the distribution. That's not very clever of me. So let's put them up here. And I should also really be factoring them in when I think about the capital call. So let's pull that down to there and that down to there. I don't know if it'll make any difference in the capital call, but it's the right thing in principle anyway. And then for the distribution, likewise, we need to include this. Okay, good. So now we're back to having 0 cash at the end, which is what we should. Okay, so then the valuation, and that can just be an XLOOKUP of these end dates into these end dates where they are here. Lock, returning from these valuations. I don't know why I locked everything. I don't need to lock anything because it's all one big XLOOKUP, but whatever. Okay, happy days. And then provisional carry. So the provisional carry, you have to think about what would the carry be if the fund is realized and distributed on the date of valuation at gross value, meaning investment valuation plus cash balance. And this is something I got wrong on the day, it would need to consider all past capital calls and distributions. So I very sillily ignored existing carry payments so that I had a provisional carry calculation that included all the carry that had actually been paid, but never mind. Silly me. Okay, so it's going to sort of follow the logic of the carry calculation. So it'll be this. So it's going to be the max of the cumulative distributions, yes, plus the cash balance plus the valuation minus the hurdle, and 0 times 20%. And then we just need to subtract off. Let's see. Yes, we'll include this period's carry, because if it's already been paid in this period, then we're fine. So let's just see, when does that start giving us money? So here, for example, the actual distributions is still only 37 million. You're nowhere near getting actual carry, but actual distributions plus the cash balance plus the valuation gets you to 124. So you get a little bit of provisional carry there. And then what I want to see is that this should go, yes, okay, so here, where you actually get paid carry, that reduces your provisional carry, and that makes sense. Cool. So then I want this plus this minus this. That's my NAV, net asset value. And then we have a couple of ratios. We want investor ratios. So we got DPI, RVPI, and TPI. So DPI is the distributed capital, distributions to paid in capital. So it's the now. Yeah, so I need to be a little careful because I've got my cumulative distributions, but I want to have my distributions to investors. So distributions to investors, which is going to be cumulative distributions minus the sum of the carry that has been paid out, because that's paid from those distributions. So total distributions end up being 176, but the distributions to investors end up being 165 because there's 11 million in carry payments. It's interesting, it doesn't actually mention, but obviously that's what is implied by net. Okay, so then the distributions to investors divided by cumulative paid in capital, that's your DPI. And let's format, comma, two decimal places, let's say. So at some point you start getting distributions here, and you've got 100 million paid in. Yep, That's all good. That gradually grows. And then you're also interested in the residual value. So basically this is the what have you already given me, and this is the what's the remaining value, which is the fund NAV divided by the paid in capital. So that's just NAV divided by the cumulative capital called, and we'll keep the same format here. So you can see right at the start, you know, you've either still got the cash or you've spent it on an investment that still has its original value. So as you would expect, this is like right at 1. Then some things, some fees start coming out, but you haven't, nothing has increased value yet, so it starts to go down a bit. And then eventually you start, exiting things, and this starts to drop off. And finally, the TVPI, total value to paid in capital, is just the sum of the other two. Okay, and I think that's kind of it, except for the scenarios. So I guess I'm going to see if I can answer some of the questions now. Okay, so let's quickly go through and see if this gets the questions right. So, okay, part 1, base case. What is the XIRR of investment 1? That's just straight from here, 69.3, 378. So that's good. When is the last investment closed / realized? That was just the max of these, which is December 32. So that's good. What is the IRR of the fund's investment portfolio? That's not actually something I had calculated, but we just do XIRR of these, all the cash flows and all the dates. And what this is 20.5452. Yes. Management fees from May 25. Is 16667. Yes. Cash balance at the end of May 25, 17416, etc. Yep. Total management fees for the life of the fund, 8275. Yep. DPI at the end of December 29. Here we are, December 29, DPI 0.62, 0.6175. Yep. Okay. Total incentive fees, total carry, 11345. Yes. Investor IRR. Now for this, I've got my cumulative distribution to investors, but I'll also need distribution to investors period by period, which can just be this minus the previous one. And then in my investor ratios, calculate net cash flow, and that is going to be the distributions to the investors minus the capital called. And then the IRR can just be X IRR of these dates and these values. And 13.2939. Yes. With a valuation of investment 39 at the end of January 2030. I haven't actually numbered these. So let's do that. Sequence 60. Okay, so investment 39 as of, wait, when did it say? January 2030, and annoyingly the dates are only up here, so that's January 2030, investment 39,3750. Yes. Valuation of all investments that are still active at the end of January 2030. So that's just this, 43,750. Yes. Funds NAV January 2030 is here. $65,170. Yes. RVPI at the end of December 2029. 5885. Yes. And I guess we might as well just make all of these 4 decimal places since it keeps asking about that. Okay. When does the TVPI go lower than 0.9x for the first time? So you can do this by formula, but honestly, the way I prefer is just to, like, I Alt Shift down arrow to select across and just look for when does. So right here, I've got a min of 0.99, 0.98, 0.91, 0.91, 0.89, and then I just shift back until, there we go. The first one is this one, which is August 27, which is what we want. When does the TVPI go higher than 1.25 for the first time? So let's see, it has not happened by then. I'm looking at this max now. So 1.23, 1.26, 1.23. Okay, so here, January 2030, which is what we wanted. When does the share of DPI in TVPI go higher than 50% for the first time? Okay. So let's just say minus minus this greater than this. And I just want to find the first one. So I'm just watching the sum down here. And there it is, November 29, which is what we want. Okay, and then part 2 is about doing the simulations. So we're going to need some data tables. So let's add a clean sheet. Get rid of the grid lines, otherwise it's not clean. And we'll do simulations. So I want to take this from here. And the other part of the simulations, which we haven't talked about yet, but because it only applies to the last 2 questions, is the return scenarios. So they have 5 different economic scenarios that affect the exit values of the investments. So let's just factor those in. So again, I'm just going to have a return scenario and just make that base case for now. And we'll also make that an input. And then here we'll just have active, and that can be XLOOKUP, this in this, returning from this. And these are by sector. So I want to affect the exit multiple, which is over here. So fine, let's pull in sector. Gonna be this. Extra exit exit bump, let's call it exit adjustment, because it might not be a bump, it can be negative. It's going to be XLOOKUP these sectors in here, returning from the active scenario. And then for the exit amount, we just want to multiply by that. Oops. Okay. Oh, sorry. For some reason I thought they all went to 0, but okay. So that seems working. So now what are the things that we need to answer in our simulations? How many of the 50 investment simulations have an investor IRR of less than 12%? So investor IRR is here. And format percent, 4 decimal places. And then what was the second question? In how many of the 50 investment simulations do not draw the whole committed capital? So let's just do uncalled. Can be, I think I linked the 100 in somewhere. So it can be this minus whatever is called at the end. Okay, and then I just want sim and sequence 50. Vary this. Calculate, and there we go. And this one I want to format comma 0. And this one I want to format. Okay, so then to answer the question, I want countifs. This is less than 12%, and that is 9. No, it's supposed to be 8. Gulp. And then here I just want countifs. This is greater than 0. That is suppose 17. Okay. Interesting. Is there one that's very close or something? 2, 3, 4, 5, C9. Okay, so I'll have to check that against the main model because I must have something wrong there. But okay, let's do the last bit anyway. For how many of the 50 investment simulations does gold case have a higher TVPI than diamond case at the end of the fund's life? Okay, so I want the ending TVPI, and that is this. Then I want to compare gold and diamond, and I want this same list of simulations. So my column input cell is that one, and my row input cell is that one. And calculate. And the question is, what's right? How many is gold higher than diamond? So I guess I'm going to say minus minus this greater than this. And the sum is 6. Okay, weird. So I'm checking out on that, but something is wrong. Anyway. Okay, what is the average return variation of the 50 investment simulations, standard deviation of the investor's IRR across the 5 return scenarios? Okay, so let's grab our 5 return scenarios. I'm interested in the investor's IRR, which I've already got here. Let's put that there, and in my list of simulations again. And I want to format percent 4 decimal places. So this is this, and this is this. Let me calculate. So many data tables. So then my return variation is stdevp of these. And I think I just want 2 decimal places of that. It's average 3.49. Ooh, so I'm a little bit off here as well. Okay, so must be something wrong. I'm going to go compare against the solution model now, and I will report back. Okay, I went and checked against the solution model. Something so stupid. So in my distribution, I said if it's a distribution period, then do all this stuff, and if it's the end, then don't have a minimum cash balance. But the end of the fund doesn't have to be, so for the base case it was a distribution period, but it doesn't have to be, which meant that if the distribution period was, say, the end of January, then I was saying in January this isn't a distribution period, and then at the next quarter end I was saying this isn't the end date of the fund, so keep a minimum balance. So I was retaining $7 million in the fund in that scenario. Stupid. So I'm just going to take this condition out of here, put it on the outside. So we're going to say if it's the end of the fund, then give us all the money. Otherwise, do the regular calculation. Oh, frustrating to end on that note, but all right, let's recalculate. Hopefully this should stay 17, this should stay 6, this should become an 8, and this should become 3.45. I must say I've recorded this video in a few different pieces, which I don't normally do, so I'm not exactly sure how long it is. It's definitely a lot less time than it originally took me to solve it. I think it's still much more than the length of time it took me to solve the first 2 cases put together, even though it's only worth the same amount as them. But I must say, doing it with a clean build and a clean approach, like it's quite a small model, aside from the bit that was, built directly by just adjusting the simulation example. It's, with the benefit of hindsight, I do feel like the claim that this would be easy flowing wasn't as crazy as it felt like while I was solving it. And maybe you feel that way after watching me go through it as well. I definitely feel like I learned something from this one. This is not my normal modeling area, and I do think I made a much cleaner run the second time around. And hopefully, the next time I come across something like this, I'll make a much cleaner run again. Anyway, that's all I got for today. Thanks for watching. See you next time.